Hey everybody, so Eric is here and I have convinced Dave Lauer, is that how you say your last name, Lauer?
Yep, that's right.
Oh yeah. I convinced him to come on and talk to us a little bit. So for a really quick bit of context, I came across him on Twitter and I did the typical Twitter stalky, creepy thing, and I just went through a bunch of his posts. And at the end of some of
Dear
that,
Lord.
yeah, at the end of some of that, I started realizing that you talk about a lot of things that I don't think are talked about enough. And the dastardly part of that is a lot of those things have kind of a sinister impact, I think, on the retail trader that they might not even be aware that this stuff is happening behind the scenes. So that is what led me to you. But first, I want to welcome you to the channel. The community is stoked to talk with you. And I would love to just start with, a little bit of your background. What is your relationship with the markets and that kind of stuff?
Sure, and thanks for having me. I appreciate the interest, and it's just still sort of mind-blowing to me how much interest there is now in market structure. And
Mm.
I love it, and I love talking about it. I'm kind of strange like that. So thanks for having me on. I've been I've had all sorts of different roles in markets. I started my career as a high frequency trader. So the first half of my career was like engineering technology and writing software, doing quantitative analysis for high frequency trading strategies. So the kind of thing where you are measuring the performance of a system in microseconds. So that's the software that I used to write. But I didn't really like that, and I left and I started working in the exchange space. So I helped to design IEX stock exchange, and then I sat on the board and still sit on the board of Equitas Neo, which is a Canadian stock exchange. And then I started working for asset managers. So I did a lot of work on behalf of some of the largest asset managers out there, sophisticated quant funds, big mutual funds, pension plans, that kind of thing, helping them understand market structure, helping them quantitatively analyze how their brokers were managing their large orders and whether they were achieving something called best execution. So I've spent a lot of time on sort of the regulatory side and the analytics side of things. I've testified before the Senate Banking Committee a couple of times on electronic markets. I've presented to the SEC, the CFTC, the OSC, and I sit on FINRA's Market Regulation Committee. So that's sort of my history in markets. And recently, I've been focused more on sort of generic AI work, but then also now I'm building something called the Terminal at Irvin Finance, and we're building a site to give retail investors access to the same data and tools that I'm used to on the institutional side, as well as the ability to do collaborative research and communal research together. And then a piece of that site will also be dedicated to education and advocacy.
That part's awesome, the education and efficacy
Yeah.
component. Well, so I think it's safe to say that, I don't know, maybe like a thing or two about the markets, maybe something like that.
I've seen some things, yeah.
Yeah, okay. So it's just good to know the background so I don't have to explain what a stock. I'm just kidding. Man, but that, like, you have talked about a lot of your background, and it's like literally just a bullet point list of things that just pop in my mind of pieces that I want to dive into. Again, just being mindful. I know that we have about an hour, so I want to make sure we have a chance to get to the meat and potatoes, so to speak. But I do have a couple questions about your background, just because it
Sure.
literally is fascinating to me. So I would be curious to understand just a little bit about the evolution of high frequency trading from your perspective. So, um, and if you could give like a quick, maybe 2 sentence overview of what it is for the folks that may not know it. The reason why I think this is a fascinating topic is because high frequency trading for a long time, I think, has been generally misunderstood by a lot of people. And it's almost like, they're ready to start throwing rocks at each other, whether it's good or bad, that kind of thing. So I'd love to dive into that just a little bit more.
Yeah, sure. So high frequency trading is essentially computerized trading at extremely high speeds. And it has evolved really since, I would say, even in the 80s, you didn't have high frequency trading, but you did have, as computers met Wall Street, people started to find structure and relationships, and that really expressed itself through something called statistical arbitrage. Like pairs trading is where a lot of this started. Emmanuel Derman's My Life as a Quant is just a great book if you want to learn about like the history going back that far. And then markets started to evolve in the 90s with ECNs, and these ECNs, these electronic crossing networks like Island and Arca, started to compete with the New York Stock Exchange and NASDAQ. And then in 2005, something called Reg NMS was passed, which is the Regulation National Market System, which kind of tied together all of the exchanges in the US into a broad national market system. And it was really that was the catalyst for high frequency trading for a bunch of reasons. I think the big one being that it introduced a lot of complexity into markets. And suddenly you had all these different exchanges, and people had to manage that complexity. And high frequency trading sort of thrived in an environment like that. And so, you had a bunch of really brilliant people starting in the early 2000s who built these computing systems that could very quickly recognize order flow, step in front of it, improve, take it down, all sorts of different arbitrage activities that by now have made it the predominant force in markets. So at any given time, something like 95% or more of all quotes in the market are coming out of high frequency trading systems. And generally, like 85 to 90% of all trades have at least one counterparty being a high frequency trading system on the other side. Now, high frequency is generally sort of a set of tools. So even large broker dealers use a lot of the same tools now that the proprietary trading firms use. But most people, when they think of high frequency, they think of these proprietary trading firms. So these are firms that are trading with their own money, and they have invested a huge amount of money into technology. So they have servers that are co-located at every data center that matters in New Jersey, because trading does not happen on Wall Street anymore. It happens in data centers in New Jersey. And so what they do is they set up dedicated lasers and wireless technologies to go between data centers and high-speed servers, and they're swapping their servers out maybe even every 6 months to get the tiniest speed advantages. They're putting trading strategies into hardware, into like FPGAs or ASICs, so it gets very complicated. To the question of is high frequency a good thing or a bad thing, I think it's really a tool and a set of technologies. The bad thing is not necessarily in the tools and tech, but it's sort of that the market is incentivized. The incentives in the market work to keep them unnecessarily complex. And as long as they're unnecessarily complex, high frequency firms sort of step in and master that complexity. And so it can often mean that these structural inefficiencies don't go away because of that complexity. So I think there are lots of problems in markets and market structure. I don't think necessarily that high frequency is the problem. It's sort of the thing that takes advantage of the problems.
That is a really interesting way to phrase it, because I think that high frequency trading for retail traders, at least, there are benefits that exist to us because of it. But I think the point that you just made in terms of the pervasiveness and really the disincentive to fix, what they're capitalizing on is a, I don't know, it's a really interesting note. So then after your time in high frequency trading, which you obviously learned a very niche part of the markets there.
Yeah, for real, yeah.
Very specific. Then you started, it seemed like you branched out quite a bit more in terms of like when you went to Equitas and like Neoboard and things like that. It seems like your overall perspective probably widened. I'm sure that you were already aware of a
Oh,
lot
very
of,
much so. Yeah.
yeah, the other things that were going on. But I would be just curious to understand a little bit about that specifically. When you moved from high frequency trading, that very niche market, to some of your broader roles, as you looked at the overall markets, what was your impression? Did you think that these, like I guess we currently know a little part of your answer is that you think that there's a lot of issues with it, but is that where you started seeing a lot of those issues? And if so, what were some of the big things you were kind of keying into?
I think I started seeing these issues uh, when the flash crash happened.
Mm,
So I was that was May of 2010, and I was on the floor of the largest market maker in the e-mini market at the time.
mhm,
That's where I was working. So the flash crash was sort of an eye-opening event for me, where it struck me that markets were becoming more fragile,
mm,
um, not more resilient. And so it was only a year after that that I left. And then I had actually intended on leaving finance. I did not like the industry. I didn't like anything about it. I wanted to go off and do something different. And without getting into that very long story, I ended up getting sucked back in when I found these guys in New York who were building a new stock exchange to address some of these issues. And I got really excited about that. And I found that I could work in finance, but on a completely different side,
mm,
trying to sort of make markets better. And so that was a fun experience for me, but it really did open my eyes. I think that you put it the right way. My experience of markets was very focused on hardware and latency and yeah, and proprietary trading. And then I started to learn all sorts of other parts of the market, like the exchange space and the conflicts of interest in the exchange space and the inefficiencies there. And then I learned all sorts, all this about brokers and how they were handling client orders, and then I got really deep into uh, how pension plans and mutual fund companies, how their orders were being handled by their broker dealers, and why their broker dealers were able to use sort of the complexity of the market to hide how they were ripping off their clients. And I was involved in this area as these enforcement actions started coming out against the biggest broker dealers, and the dark pool cases from the New York Attorney General's
mm,
office and FINRA crackdowns. And so, I was kind of, and that was when I was in New York, and I was kind of like in the heart of all of this as it was taking place. And I started to learn more about regulation. And so, I've sort of had a bit of exposure to most of the ecosystem, and that has definitely been eye-opening. And I think these themes of sort of conflicts of interest and complexity and incentives, they repeat themselves everywhere within the industry. And I think there are real good opportunities to fix these things, but it's problematic to find the political will to fix these things, because a lot of people make a lot of money from these inefficiencies.
mm. Yeah, I think that just like you said, the pervasiveness of just undue complexity has always been
Hmm.
something that my mentor is telling you about. Myself, we talk about that even for the retail trader at the lowest level, just terminology. We just
Yeah,
start using a bunch of
absolutely.
words
Yeah.
that we
Yeah.
probably don't need to use, but that's just your very first barrier to entry is you have to speak the language.
Yeah,
And
yeah,
it's
and the jargon is it's hard to crack. It's hard to crack it. It's hard to find even good online resources.
yeah. Well, it's
Yeah,
almost like some of it becomes slang. I mean, even if you take the word long and short,
yeah,
you know what I mean? You could come up with 15 derivatives of each depending on, what context those are used in.
yeah.
You could be
Even like the word stocks, like I never use the word stocks. We
right.
only talk about equities, right? And
Yep.
and so but the average person, they don't even know what an equity is. They're like, oh, a stock, and a bond, not equity and debt. Like even stuff like that.
Yep. Yeah, it's interesting and I imagine like I can't even fathom the level of complexity for some of the things that you've seen, but I can definitely respect that it seems to be a cascading function where it just starts to get more and more
Yeah.
contorted the further down the line that you go. Something else in your background that you mentioned that I think is really interesting is just you were talking about being wrapped into testifying, or I don't know if that's the right term for,
Hmm.
did you actually testify or?
Before the Senate Banking Committee, yeah, twice.
Okay.
Yeah.
So could you talk a little bit about that experience? I'm just curious, like a quick background on what the issue was and then what you were talking about.
Yeah, they held this hearing in 2012 where they were trying to better understand electronic markets and high
Mm,
frequency trading. And I was sort of in a unique position because there weren't really any. I mean, there were, a handful of us who understood what high frequency trading was, but didn't work at a high frequency firm or a broker or an exchange. And so that was a pretty unique position to be in, and the Senate Banking Committee was very excited about that. And so they brought me on, and I, testified alongside some academics and some asset managers and some exchange executives. And it was really an opportunity to give Congress an independent perspective on complexity in markets and whether regulators were doing a good job. And it was the same thing when I testified before the SEC or presented to their Equity Market Structure Advisory Committee, or the same thing with the CFTC's Technical Advisory Committee. These were just opportunities to give them a voice that they weren't used to hearing,
mm,
because most of the voices that they heard just talk their books. And do so relatively blatantly. Like, you could have someone who works at the New York Stock Exchange uh, testify on one side of an issue, and then they can go to Citadel, and then they can be on the completely opposite side of the issue and make an equally impassioned case for it. And I found that kind of thing disheartening, because generally, regardless of the seat that I've been in over the last, let's say, 8 or 9 years, my views have stayed relatively consistent in terms of the changes I'd like to see in markets. So I can tell you that it was a nerve-wracking experience. It was terrifying, and I didn't, I'm actually not a very I'm not very comfortable when it comes to public speaking, though I do it a lot. But back then I was especially uncomfortable with it.
mhm.
So I didn't even like sleep the night before. but it did seem to go very well, and they asked me to come back 2 years later. So
You were
that
probably
was
like, "Oh
pretty cool.
shit, I don't get to sleep again."
Yeah, exactly.
We have a saying in the military. I'm sure it exists elsewhere, but no good deed goes unpunished. So that
Yeah, that's right.
you did a good thing, and they're ready to give it to you again.
Right, right.
So,
But it's also, it did lead to me being on this FINRA market regulation committee, which I
mm,
really do enjoy. Um, and that's another good opportunity to sort of represent the public to FINRA, who FINRA is in charge of broker-dealer oversight and enforcement. And I've found that to be a great experience.
so it sounds like you could be considered a Robin Hood of retail traders. What do you think of that?
Uh, I don't want to be associated with what
Yeah.
they've done, but yes, I try and be independent. I try and do the right thing. I take it very seriously. I don't want to mess up markets. The markets are one of the U.S.'s competitive advantages in the
Yeah.
world, and I want to see the U.S. succeed, and I want that success to be fairly and evenly distributed. And so, I do take this responsibility very seriously.
I think that that's really cool. And I obviously, before having this conversation, I really did get a gist of that as I was stalking you online. You might have seen me outside your window or something, but that was just, but it's really, I don't know, for retail traders like me, coming across people like you actually puts a little bit of wind in my sails, because I think I say it all the time, like on my trading channel, I say for like a retail trader to be successful, they like literally have to be an outlier from a
Mhm.
statistical
Yeah,
standpoint. The
absolutely. Yep.
vast majority do not make it.
Yep. And the more
So
you trade, the less likely you are to succeed.
exactly. And it's one of those really difficult paradigms, because there can be benefits to trading for retail traders. It exists. Some people are able to figure it out. I, definitely think that my mentor is really the only reason why I've stuck with trading, because I know shit had somebody to look at. He would show me everything.
Hmm.
And I had the ability to like watch somebody be able to navigate it. and then start to realize how much work goes into that, especially when you realize how structurally the markets are built. And I mean, it doesn't favor the retail trader, that's for sure. So I feel
It
like,
does not. Yeah.
yeah, I feel like it's swimming upstream in a lot of ways, but talking to people like you that like no shit are like trying to make it at least not even necessarily better for the retail trader, but just fair is
Yeah.
something that I think is it's really cool. It's really cool to see, especially because I know that that is not the real trend, in that industry. Most people would be completely fine going to the bank, making their money, and then just keeping it up. So it's cool to hear your involvement with that. I had one more question on that experience, though. When you testify to, just these different bodies, what is their reception to the information you are sharing with them? Are they completely sidelined? Can they not believe this is happening? Do they not believe you? I'm just curious to understand a little bit from like the regulation side, how they receive the information you share with them.
Yeah, that's a really interesting question. There are two sort of categories. First, I think there's politicians and staff,
Mm,
and that's true in Congress, and that's true at the regulator. The politicians, some of them um, on both sides are very receptive to it, and some of them are very not, because there aren't campaign contributions that come along with my viewpoint. Um,
right.
and that is broadly bipartisan. I will say that I have found on both sides that there are politicians that are very receptive to it, though. The staff tend to be different than that, and within the staff, like the research staff and legislative directors and advisors in Congress, there's a lot of interest, but there's just sort of this paralysis. I mean, as most of us, I would assume, know, there's simply political paralysis in the U.S. Nothing can get
Right.
done, and this falls into that. There are legislative efforts to reform markets in the ways that I want to reform. They're not going anywhere, and there are legislative efforts to fight that, and they're not going anywhere. And so the status quo just sort of continues. At the regulator, it's pretty similar. Like at the SEC, commissioners are broadly politicians. Now, market structure is the kind of thing that, while not necessarily partisan, you do tend to see that the Democrats are more interested in the kind of reforms that I push than Republicans. But I don't think it's like an overwhelming thing from that perspective. You would, for example, there's one of the Republican SEC commissioners would very much agree with a lot of what I say. Um, and he's relatively sophisticated on market structure, but the Democrats would probably be more forceful on some of these issues. So, because of that, I do think that over the next year, we're going to see some pretty dramatic market structure changes, especially that will impact retail, focused on payment for order flow and off-exchange trading. And so I'm very excited for that, because I think that the current chair of the SEC, Gary Gensler, that this is an issue that's important to him. And as long as an issue is important to the chair of the SEC, something can actually get done
Tends to get
about it.
focused on.
Yeah.
Yeah. Yeah. That's Well, you just did a little bit of subtle foreshadowing there on a couple of the questions I have for you. But before we get into good old PFOF, I do want to talk to you just a little bit about just your general perception of the markets, whatever that question means to you, over the last year. I'm curious what you thought about 2021 if you were to summarize the general market activity.
What a year. I mean, it's been crazy. Where do you even start? Like it's just uh, an amazing year for markets. I mean, first, it's been really easy to make money. So I think a lot of people have made a lot of money, and that's a great thing. I think it's been awesome to see this massive increase in retail involvement and retail interest, and
Mm,
and you see that.
we're back.
Okay. So I think that this new presence in markets is a really good thing. And what I'm really excited about is that retail wants to learn about markets, not just trade in them. And I think that that is probably one of the most unique forces that we've seen in modern times, because for many, many years now, firms like Citadel and TD Ameritrade and Schwab and E-Trade, they will stand there and they will say, we represent the retail investor. They will push for the changes in markets that benefit them, while pretending that those changes benefit retail. And I think this new level of understanding that retail has, hopefully, is the kind of thing that can actually shape markets to truly benefit both retail and institutions, because it's important for people to understand that the majority of retail wealth is in institutions. Majority of retail wealth is in mutual funds,
Right.
pension plans, and ETFs. And so we should want markets to work for institutions just as much as we should want them, or even more than active day traders. And so, I think that this has been a really interesting transitional year for markets. And I think that next year is going to be sort of a transformative year for them.
I think next year, just from a couple conversations that I've had, I think next year is going to be fascinating for a lot of reasons. I actually wasn't necessarily approaching it too much from the regulatory standpoint. I want to ask you a little bit more about that, just to understand, kind of what changes you're expecting. But before we dive too far into 2021, I would be curious to understand a little bit more your thoughts on the Fed's monetary policy for this past year and how effective you think it's been.
Well, it's been effective in juicing the market. So, if that was one of their main measurements or outcomes, they've been very good at that. I mean, you can look at it. Fed has a dual mandate, right? And that's price stability and employment levels. And I think from an employment perspective, the U.S. has done amazingly well. It's probably one of the fastest recoveries. I think maybe it is the fastest recovery in history from a massive disruption and dislocation. And now the question is, does inflation outpace the recovery, right? So I happen to be in the camp of this is relatively transitory inflation.
I was
So
just
yeah,
going to ask that question.
I'm going to put my macro cap on. I did study economics. I do pay attention to it. And I think this is, I think when you look at the inflation numbers, you're looking at them relative to a year ago.
Right.
And that's a really important part of the story. And so if you look at the overall path over, many years, you see that it's not, we're not extremely inflationary. We're kind of just getting back to the path we were on. And we should want some inflation in some ways right now, because it's actually been hard in recent times to get inflation over 2%. And I think as long as we continue to see wages, and yeah, the most recent readings weren't great on wages, but overall, we have seen wages increasing, and that is another sort of unique part of the recovery. So I think as long as we continue to see wages increasing, that this will be a strong recovery. And I think that in 6 months, for example, when inflation is relative to this past summer rather than the depths of COVID in 2020, it'll probably tell a different story. I can't, I'm no expert. I'm not a PhD at the Fed studying this stuff, but I will mostly defer to them, because I still think that, broadly speaking, this is a strong economic recovery, and a little inflation during an economic recovery is okay. A hyper, and again, I think we should hopefully start to see, we're going to see the Fed taper, then we're going to see them start to raise rates, and we'll see how strong the recovery really is at that point. I'm surprised they've been so dovish this long, but they've got a lot more information than I do on it.
Yeah, that's fair. I was just having a conversation last week with a gentleman, David Hunter, and he's kind of a macro view kind of guy, and he said something that gave me a lot of perspective again, because I started trading like 2007. So I only have a small window realistically that I'm looking through.
Hmm.
And one of the things he was talking about, I think it was in the 70s, maybe the 80s, 70s or 80s, where, inflation was like 20%.
Hmm.
And,
Yeah.
it's just hearing
And then
people.
Volcker had to come in and raise interest rates to like 10%. Like
Right.
that's wild, right? And this is just nothing relative to that.
Exactly. And I think that for a lot of folks, especially for those that just started trading in the last couple of years, inflation and things like that have just been, pegged at a floor. So then as soon as they start seeing any of it, they're like, what is this? 6%? Get out of here. And it's,
I know
just in,
exactly. Yeah.
yeah, in the grand scheme of things, I think it contorts what healthy actually looks like.
Yeah,
Um,
and I should also, I should mention, so I mean, I started my interest in markets started in the mid 90s as a kid, as like a high school student. Mostly because I was a geek and I loved technology, and
mm,
the tech companies were sort of the thing in the mid 90s, and then I got really into it and I was trading a lot, and then the dot-com bubble burst. And then I also started my career on Wall Street in 2005, and I lived through 2007 and 8. Um, and so, I've seen a bear market, whereas, you know, a lot of people in markets today haven't. And so I do think that that's going to be somewhat of a rude awakening
yeah.
for a lot of people, because a bull market is a uniquely easy way to make money. And a bear market, it's like they say it's an escalator on the way up and an elevator on the way down. That shit drops.
Yep.
And so, I do think that people have to always keep that in mind, and especially focus on risk and risk management. As markets might get more volatile, it's bear markets. They seem to be, we have experienced corrections, and they seem to be very fast all of a sudden.
Yeah.
I'm not going to pretend to say that I can predict where prices are going, but they are inevitable, these corrections, and a bear
Right.
market is inevitable.
Right.
And so, I just always want people to bear that in mind, that the last, let's call it 13 or 12 years, that's been the absolute, I think, longest bull
Yep.
market in history.
Yep.
And as a student of history, try not to miss out on that.
Yeah, I think it's something that I talk a lot about, that if you're a trader, your number one job is risk management, exactly like you
Hmm.
said,
Hmm.
because we all want to make money, and Warren Buffett, I'm sure, is super smart with his list of make money. So I don't disagree with that, but I think that for people who are actively trading, you're never going to make money if you can't control your risk. And I think that a lot of folks have like a very skewed perspective of what risk looks like, or even what a bear market looks like. I was looking at a study. I don't remember the specifics, but to paraphrase slightly, the average bear market is something around like 250 days in duration.
Hmm.
And then, a lot of people that went through the COVID drop are sitting there thinking, well, oh, because technically, I mean, that's a bear market. It definitely
Right.
declined,
Right.
over 20%. And then a lot of people, oh, well, bear market's not that bad, especially when you get this just parabolic
Yeah.
V shape out. I think that it contorts again the perception of how this whole thing actually works, and it sets people up. Um, a lot of systems worked, over the last few years. You could throw a dart at a
Sure
dartboard
did.
and be pretty
Yep.
good.
My
Um,
dad used to tell me, when I told him I thought I was a good trader, he's like, in a hurricane, even turkeys fly.
I like that. Yeah, I like that. It's my
Yeah.
my mentor. He says a lot. Markets crash down, not up. And then
Right.
I literally messaged him the last year. I was just like, "What was that saying you said?" Because it looks like we're going up.
Yeah. Right.
um, so one more question before we get into kind of looking forward a little bit. I'm just curious your perspective on cryptocurrencies in the marketplace. It's something that I think it's important to talk about because it's here, and it's definitely, I think, a significant a growing part of the marketplace. I mean, we even just opened up, micro Bitcoin futures, let alone not even just Bitcoin futures. And then we have the new BitO ETF, which I absolutely hate, but it exists.
Yeah.
So, it's definitely being adopted. We can't really look past that part. But just curious about your perspective on cryptocurrencies in general and how they fit into this bigger picture.
Yeah, I crypto is fascinating to me, and I've been fascinated by it since I found Bitcoin in 2010. And Bitcoin, in fact, was my best and worst trade ever,
That sounds
all in
right.
one. So I don't know many people that can say that. I bought Bitcoin at 2 and I sold it at 1,000,
That's a good run.
which is a crazy trade, right?
Yep.
Who wouldn't?
Yep.
And then it went to 50,000. So
It's funny you say that. I literally have a very similar story. When cryptocurrency was first becoming a little more mainstream in like 14, 15, I started scooping up just a little bit. And I
yeah,
literally did the same exact thing. I got out way too early. And then
yeah, I was a trader and I
yep,
traded it, and that was my
yep.
mistake. My
It's,
friends who were true believers, they made their money, but they'll never sell. So, you
yeah,
got to be on one side or the other, I
we
guess.
all have a little bit of degenerate in us.
I mean, if you love trading and volatility, cryptos are awesome.
Yeah,
I don't trade much. I consider myself broadly sort of a long-term holder in almost everything I do.
smart.
And I think I consider crypto within that. I did go back in and I have made great trades in crypto, and it hasn't been terribly difficult to do that. Um, I think it's a space. It's sort of like the Wild West. It's like anything can go, and I think you need to be really responsible, and you need to expect stuff to drop by 80 to 90%. And if you're comfortable with that kind of risk, the upside is really staggering, right? So the risk reward in crypto is what I find most compelling. Like
Right.
I can put, let's say $1,000 into a position and it could go to 100,000 or it could go to zero, right? So that
Right.
that kind of risk reward is exciting and
Yeah.
intense. And so, I do think that you have to be careful if you're not a technologist in crypto. I feel good because I can get deep on the tech. I made this. I like this one crypto. It's called Avalanche, and I found it in January because I watched this video on its consensus algorithm. Like the inventor of it described the very deep detail of its consensus algorithm, and I found it really compelling. And I bought it, and that's been a fantastic position to have. But again, that's like if you don't understand things at that level, then you have to be careful because there's a lot of fraud in crypto, and there's a lot of what's called rug pulls where
Yep.
you're if you don't understand the tech and you're signing over your crypto to some smart contract and you don't know what's in it, they could just take that right from you. So that's the only thing I would caution against. But I think either Bitcoin is a Ponzi scheme or it's the future of money, right? And so again, it's like it might go to zero or it might go to like $1 million of Bitcoin. I don't know.
Right.
And I like that kind of risk reward.
Yeah. Yeah. Exactly. I think that's the Wild West. I like
Yeah.
really keyed into that because I think that that's such a great way to frame it, because I think what makes cryptocurrency so fascinating is just the level of disruption that it brings to the table that
Hmm.
you can't really deny it. It's there.
Yeah.
Um,
And I
but
like how
yeah,
it disintermediates things. It gets rid of, can get rid of brokers, and it can get rid of inefficiencies. But at the same time, that means you are more exposed, right? You have to be
yeah.
smarter about what you do, or else it's easier to rip you off. You don't have the kind of protections in place in crypto that you have in the regulated securities market.
Yeah, and I think I've been following pretty closely. I have a few friends that are in the cryptocurrency industry. Well, really blockchain, I should say, a couple in cryptocurrency, but um, a lot of them, talk about just adoption and how different economies are going to view
Hmm.
Bitcoin. I mean, you have pretty big places like China that are just like, no,
Yeah.
we don't like this, and then yes, and then no. They kind of flip flop a bit, but I think that That's an interesting part of the equation in terms of just what the future for Bitcoin looks like, because it does
Mhm.
seem like there's some desire for adoption, but I also imagine big banks might not be super stoked on it because it's going to pull certain levels of business from them. But yeah, it's interesting, to hear you frame the risk to reward aspect, because I do think that that's something. If you could, offer $1,000 and your max risk goes to zero, or it has the potential to go to wherever it goes to, it's interesting. It at
It's
least,
interesting,
yeah,
yeah.
it's at
You
least
know, you
interesting.
you can roll the dice on some of them, but if you're comfortable losing that money, that's a fine place to be. I think, that's how I look at a lot of my positions in crypto.
Got it. And so, just one more question on cryptocurrency. I think that cryptocurrency in general steals a lot of the limelight of like blockchain technology at large, and some of the potential applications of blockchain technology I think is really interesting. But from a specific cryptocurrency conversation, what are your thoughts on the fact that on, just any given day, there's a gajillion different cryptocurrencies available?
Yeah, it's
For
impossible.
Yeah,
I don't even try to stay on top of them, and
so
if I do, I go down a rat hole.
how do you find like cryptocurrencies that you're interested in? One of the ways that my buddy, again, who's in the space, framed it to me is he looks at it as, what does this cryptocurrency do that doesn't already exist and have traction? So you have things like Bitcoin, Ethereum, things like that that have their own niche, so to speak, in terms of what they provide as far as a cryptocurrency. That's his general take, but I'm curious what yours is.
Yeah, I like to look for utility. I think
Mm,
that's the one of the biggest things, and which is similar, I think, to what he's saying. Which is, and
agreed.
and is this something that can change an existing application in a good way? Is it something that can decentralize or disintermediate, but that there's a reason for it? Like the first question when you think about blockchain, you should ask is, why not a database? Because databases can do a ton of stuff. And sometimes there are really compelling reasons for why not a database. And I also like to look for things that are less known, but that's hard. I'm sort of I can glean things from social media that send me down interesting paths, and I'll probably take action on one out of every 100 of them. And so
Right.
it's maybe once or twice a year that I end up in a substantial new position. But like I mentioned before, if you do focus on a single ecosystem, it can be a bit easier. Like
Mm,
Avalanche is the one that I focused on because I think technologically it's got the best story, and focusing on that has made it easier to separate the signal from the noise. I would say, if I'm right that it's going to be one of the top chains, then some of the applications on it are probably also worth focusing on, and so that's how I've approached it.
that makes a lot of sense. I asked that just because a lot of people out there don't necessarily share the 10-pound brain that you have, and have more like the Neanderthal setup that I possess. So it's helpful, to talk to folks and understand different ways to sort through the noise, because I do find that to be
Yeah.
one of the most frustrating things about the cryptocurrency space is you have all this. It's really difficult. You
Yes,
could like
yeah, and
pull up
and
a
even for
list.
me, like I have found trusted sources of information, and so I will lean on them and their analysis. Like I found good analysis, and I will, usually defer to them if they make a compelling case. So I do think finding trusted sources is incredibly important in the space.
What are your favorite ways or favorite trusted sources that you can share?
Oh, there's this one. What is it? Yeah, it's called Crypto SEQ, Crypto Seek. Um, I have found them to be a fantastic source of tips and information. They're very much an Avalanche fan, so they've pointed me to some really compelling Avalanche tokens, but they also do some research outside of that, like the
Cool.
injective protocol, which is a distributed exchange on Ethereum, is another one that I remember finding from them. So I think they've been a really good source for me.
Got it. Yeah, that's awesome. And it doesn't, is that supposed to be like crypto sequence, or is that supposed to be like crypto seek?
I think crypto sequence. Yeah.
Okay, good. I was just making sure that they didn't, do one of those weird spelling things, and then you got to
Yeah.
like question whether or not you actually like them. Because if that was
Right.
going to be
Right.
crypto seek, you actually trust those guys. But okay. um, all right. So we have a little less than a half hour left, and I would be remiss if I didn't save us time to talk about really the main event of the video here, and that is, do you think Daddy JPow's printer machine still has paper left? Um, on
No.
a yeah, I imagine he's got to be borrowing paper at this point. But
Well,
um,
look, I do think that I don't know how much you've delved into sort of MMT and that kind of thing, but uh, it, I do think that this has been an experiment in modern monetary theory, and it's going well so far. I think it's actually relatively impressive natural experiment so far.
yep.
Now, I think the answer is only going to become clear over time. Um, and who knows what it's going to look like. But it does seem that the U.S. is able to print money at will, um, and to backstop the economy in a way that we didn't really think we could, let's say, in the 1930s. And I think we've avoided a Great Depression,
Mm,
which I think is a really excellent thing.
yeah.
And I think that we've even done it better than the Great Financial Crisis, in which we did again avoid a Great Depression, um, but we sort of distributed the protection very unevenly, and I don't think that we should be proud as sort of fiscal authorities of what happened in 2008,
Right.
by bailing the banks out and having people, a lot of everyday people lose everything. I think we should be ashamed of that. And I think we should be ashamed of not sending people to jail from that and since then. So, but all of that being said, I think that they have spent their ammo and it's worked, and hopefully now it's time to draw it back a bit slowly and let this economy sort of continue to take off. And maybe in another 5 years we're talking about what a massive success story this all has been. I hope that's the case as opposed to the alternative.
Well, if things just get shitty again, just turn on the printer. And so
Sure.
far, that
It seems like it. It's
it's
wild. I have friends that are on fixed income desks, and for years they've been talking about how distorted the markets are because of the Fed. Um, and but at the same time, the proof is in the pudding, right?
right.
And the economy has recovered, and so maybe they did it.
Right.
I think we'll find out.
Interestingly enough, well, I I think that it's like I tell my wife all the time. It's why I like to use a credit card, because it's fake money. Nobody ever comes looking for it. You just swipe it and forget it. And
Right. It's like Bitcoin. It's
right,
imaginary.
right. It just it's interesting though, because I think that the joke about the printer it's a hilarious joke, but when you actually like frame it the way that you did, it has been shockingly effective thus far. It is difficult to tell, kind of like, Agent Orange and things like that does real good at a job, and then you might not know the
Yeah,
output,
yeah, for
till a
real.
little bit,
Right.
till a little bit later.
Yeah.
But so far, so good.
Yep, yep, yeah. I think my father-in-law had been exposed to that in Vietnam, so
Awful, awful.
but I do think that the concern in terms of like the equity of the distribution of gains is very legitimate, and I think that that's something that we need to address next. I think the U.S. economy is one of inequity, and it's very much sort of structurally ingrained in that way. So I think when we look back at this period of time, I hope we can learn from it and continue to improve. I think that what we're experiencing now is based off of the lessons of 2008. And I
Right.
hope we continue to sort of learn lessons and figure out how to do this better and better each time.
So on that vein, we have maybe 10 minutes left. I would definitely like to actually talk about the for real main event, which is that of just off exchange volume. So
Yeah.
when we
Yeah.
talk about equity and we talk about fairness, you posted it was actually like super funny because I think it was from the Financial Times. I think I literally came across a very similar graph that essentially just shows, the decline of on exchange volume
Hmm.
and just the centralization of off exchange money movement. Um, I would love to just get first your overview of even what that really means as exchange volume starts to center off the markets, that kind of thing. I'd be curious to understand that first, and then I have a couple specific questions to follow up with.
Sure. So I'll try and be quick, but the purpose of the stock market, there are two reasons the stock market exists, and it's easy, especially as traders, to sort of lose sight of this. But the market exists for capital formation and price discovery. That's it. It doesn't exist to be a casino for speculators. I mean, it can act that way at times, but the stock market has a real economy impact. It impacts people's lives. It impacts companies' ability to raise money and grow and hire people. And when you start from that perspective, then you need to think, okay, so how can we get it to do that job in the best way possible? And capital formation is one thing. That's sort of the IPO process, the offering process, and it tends to be good but not great. But it does the trick sort of. But the price discovery side of thing is the secondary market. Is what is this company worth? And that's an important question to be able to answer. That's the root of capitalism, is
Right.
using markets to determine the value of things. And so we determine the value of things based on what people will pay to buy or sell something. And that expressing that interest to buy or sell something, it happens on stock exchanges. Um, and so when we trade away from the exchange, that can be good, except that there is a cost. It's not just a benefit, right? Trading off of the exchange means that you're free riding the quote that's on the exchange. So someone is
Right.
willing to post an order. They're taking risk by putting an order on the exchange. They're saying, I will pay more than anyone else. And then someone off exchange here says, oh, okay, great. Well, I'll sell it to someone for that price. I'll use that price. But that trader doesn't get any compensation for the risk that they took. And so that acts as what's called a disincentive to market making, because it means
Right.
that what's taking place off exchange damages what's happening on exchange. And it means that somebody stepped in front of the person who was on exchange. The person on exchange was there first, but the off exchange trade happened anyway. So I think that's just sort of a summary of the issue. And it's not really an issue at small volume. So take Canada, for example, where off exchange trading is anywhere from like 8 to 10% of all trading. That's a very reasonable amount. And sometimes you need off exchange trading for large asset managers who want to trade big blocks.
Right.
They don't want to post a 10 million share order on the exchange or the price goes crazy, right?
Yep.
So, and they might find someone who wants to sell another 10 million shares to them, and they might find each other at the midpoint. That's a great outcome. But for traders, generally speaking, especially retail, most of the time, you are going to send an order through your broker, and that order is going to go to Citadel or Virtu. They are the main off exchange market makers, and they will take the other side of that trade. Now you get your fill, and maybe you get a tiny bit of price improvement.
Yep.
Most of the time it's a mill. So
Yep.
it's 1 cent per 100 shares. But they can earn the spread or maybe more, right? So that's what they're trying to do. But what we've come to in the US is something like 40 to 45% of all trading is now taking place off exchange. And that's very damaging to the exchange based quotes. And so it widens the spread on exchange. And that's the most important idea to understand. High
Right.
off exchange trading widens spreads. And a good study came out that showed that it widens spreads by potentially 25% or more. And so when you get your 1 mil of price improvement off exchange, that price improvement is being measured off of a wider spread. So
Right.
you're not that's like, the Black Friday sale where they raise prices by
Right.
50% and then they're like, hey, here's 25% off. You can't lose. But that's not, you're still paying more. And so
Right.
it's a problem for retail traders, and it's especially a problem for institutions. And so I believe, as a capitalist, that trading should happen on exchange and that there should be open competition for that order flow. So instead of just these two firms, Citadel and Virtu, competing over this order flow off exchange, I believe all order flow or most order flow should be brought on exchange, and you'd have 1,000 market makers competing for it.
Right.
Spreads would compress. I'm sure you'd get more price improvement than what these guys are giving, and it would be far better outcomes for everyone. It would lead to stronger, more resilient markets with greater diversity of participants, because more trading strategies would then be profitable instead of
Right.
just these crazy low latency trading strategies. So to me, it's very much a win-win proposition. And I believe it's the kind of thing that the SEC is going to be looking to reform probably any day now, because this is an area of focus. And all the things that I've just said, the chair of the SEC would not find any of this controversial. He said many of these same things.
That's well, first, it's really cool to hear that he supports that. I'm curious to know how in your opinion, how does like payment for order flow and like smart routing, how does that fit into that bigger picture of off exchange volume? Do you think that it exacerbates that problem, or do you think that it's a potential solution to just the increasing order flow off exchange?
I think when I talk about these issues, I really like to focus on this off exchange trading, because payment for order flow, while it's a problem, it's part of a set of incentive problems that exist on exchange as well, because exchanges pay rebates for order flow
Right.
also. So I think that we should deal with any incentive that is not based around execution quality, and we should get rid of those incentives. And brokers should be strictly routing for best execution and nothing else. But the reason that so much trading happens off exchange is not just payment for order flow.
Got it.
It's a complex set of problems that include the self-regulatory structure and exchange immunity and all sorts of stuff that are part of the unnecessary complexity of markets. So I think if we simplified market structure, we reduce the number of exchanges, we push all this trading on exchange, simpler markets would be better markets.
I love that. And that's a perfect point to end the video. I think that
Great.
I actually would love to discuss with you another time just a bit more of the intricacies of the off market volume. I think that it's definitely kind of a niche discussion, but I think that it's, at least personally to me, fascinating to understand like what's going on that side of things. Because like I said, earlier before we started, this is something that I've been discussing a bit with my mentor, and some of the points you raise are familiar to me,
Mm-hmm.
but some of the things that you've just alluded to are not. And I
Mm-hmm.
would be curious to learn more about that at some point. But until
Sure.
next time, definitely really appreciate you taking the time to chat with us peasants. My band of miscreants and degenerates. But
I
most of
love
us,
the degenerates, don't get me wrong.
yeah, like I said, we all got a little bit of degenerate in us.
That's right. That's right.
But
You have to if you're involved in crypto, that's for sure.
yeah, I just feel like for retail traders, like the odds definitely are stacked against us. But I think that, like, to your point, developing a more well-rounded understanding of the space is helpful. It's helpful to frame some of the decisions that we're making. And so thank you for taking the time to share some insight
Sure.
with us. One other question I have for you is, how can people find you? I know that you're on Twitter. What's your Twitter hashtag thing?
Yeah, I'm on Twitter, D Lauer,
Okay.
DLAUER, and that's the best place, I think. And I'm building this new application called the Terminal at Irvin Finance. So you can go to URVIN, Irvin.finance to check that out. If there's interest, we did a crowdfunding, so we actually wanted to raise our money to fund it from the users, from the
Oh,
people that
very
would be
cool.
using it. So that's been extremely successful, and we've gotten 1,600 investors and almost $1.4 million. So that's been really awesome, and it's still open if anyone's interested. But hopefully, early next year, you'll be able to use the site and just get better access to much better data and tools. And I'd be happy to come on and show it at that point
That'd be
and talk
super
more
cool.
market structure.
Yeah, that would be super awesome. Cause the stuff you're working on, I think is super cool. I would 100% be a user of that. Cause I've had a few friends with Bloomberg terminals and things like that. And you start to realize
Hmm.
like what else is out there and like what
Yeah,
retail traders can see. And you're like, we're trading blind, dude.
yeah,
Like,
exactly. That's
I'm
right.
sitting here, I'm seeking alpha, getting a push notification, and you're like, oh, great.
Yeah.
Well, thanks again for your time. Really appreciate you having you. And I am 100% looking forward to bringing you on for another session in the next couple months or something like that.
Sounds great. Yeah, thanks for having me.
All right. Thanks, Dave.
Mhm.